So good afternoon, ladies and gentlemen, and welcome along to our webinar Taxing Times, which we're holding in conjunction with the Chartered Accountants Ireland, Ulster Society, London Society, and our sister society, the South African Institute of Chartered Accountants. So I think today's event represents the wide international reach of the Chartered Accountants brand, and it's great that we have this opportunity to collaborate with the South African Institute of Chartered Accountants and indeed the Ulster Society and London Society. And of course, the key with these type of collaborations is to find a topic that's of common interest to all our members. So it is great that we have this opportunity to come to you today with that particular topic, which of course is UK tax. Now we have over 430 members after registering for today's event. So I think that you'll agree that this really is a topic that demonstrates that there's a huge interest in. So our speakers today, we have Leontia Doran, who is a chartered accountant and is our UK tax specialist here with Chartered Accountants Ireland. Leontia has over 25 years experience in all things tax, and she is our lead advocate in representing the voice of chartered accountants in all our dealings with HMRC and the UK government. And Leontia is going to talk us through the corporate side of the UK Finance Bill 2021 and key tax changes. And we also have Willo Renehan, and Willo is Deloitte private tax partner, and he specialises in advising energy and tech companies and deals with a myriad of issues, including IP management, funding, and employee remuneration. And of course, he's just the type of person we need talking to us today about the government COVID-19 supports and the risk issues that businesses need to be mindful. And of course, the exit strategies that businesses will have to be considering now that the lockdown is lifting and these supports will be withdrawn. And we also have Tiarnán O'Neill, and Tiarnán is a chartered accountant and group finance director with Galgorm Collection. And their business includes the running of an award-winning hotel, spa and golf club in Northern Ireland. And Tiarnán is very kindly going to share with us his experience of running a business through COVID-19 and Brexit. So just to give you an outline of the agenda for today, each of our speakers will talk to you for about 15 minutes, and then we will have a Q&A session at the end. So I'd invite you to put in your questions there on the question facility on the course here today. And I'd also like to tell you that today's event is being recorded and a link will be sent out to you on conclusion of today's webinar. So because we have such a packed agenda, I'm not going to delay you any further. I'm going to pass you over to my colleague, Leontia Doran.
Firstly, I'd like to say that I'm really, really delighted to be here today to update you on one of my passions in life, which is tax. Obviously, as Norah said, I have a significant level of experience, and my main role in the Institute is as their UK tax specialist. I'm also really delighted to have our international colleagues from the South African Institute of Chartered Accountants here today as well. And bearing in mind that the Northern Ireland accent is notoriously fast, I certainly do my very best to make sure that you can understand what I'm saying here today. But what I want to focus on is some key announcements from the Finance Bill, which obviously was preceded by the budget in March, and not just the actual measures themselves, because at this point, most people will be well aware of the actual overarching measure, but focusing on where risks lie or where there may be opportunities and key areas to watch out for. So I want to start first with the announcement of the extended loss carryback, which is available for businesses. That was announced in the budget and is contained in the Finance Bill. Firstly, just to say, we're very pleased to say that this was actually a recommendation of Chartered Accountants Ireland in its July 2020 next financial year position paper. And essentially, this measure allows trading losses to be carried back, not just to the previous 12 months as they normally can be, but carried back to an extended period of 3 years. So clearly this will allow for much earlier recognition and relief for trading losses and improved cash flow position with tax refunds for struggling businesses. But just to highlight some specific areas to watch, and of course, tax being tax, the devil is always in the detail. Firstly, the relief is available to both companies and unincorporated businesses, but it's not unlimited. There are specific caps that apply to each tax year or accounting period where the loss is carried back beyond the normal 12 months. So for unincorporated businesses and for companies that are not members of a group, the cap is £2 million of trading losses for 2020, 2021, and 2022. However, for companies that are members of a corporate group, the £2 million cap applies across the group as a whole. So there will be a decision to be taken in respect of that cap, how to apply it most tax efficiently. But just note, there is no cap when the loss is carried back in a corporate situation against total profits of the previous 12 months. However, the rules which restrict the cap on certain income tax reliefs for individuals where the loss is carried back to the previous 12 months against other income sources that the individual may have will still apply. So you need to be careful of that particular rule. Now, in terms of the loss carryback, it must be performed on a LIFO basis, i.e. looking at later accounting periods or later tax years first. And in terms of how that relief is claimed, the extended loss carryback for companies must generally be made in a company tax return. But we've just recently had guidance from HMRC that sets out there is a de minimis limit whereby a claim for amounts of 200,000 or less can be made outside a return. We are, however, awaiting on more detailed guidance from HMRC in respect of unincorporated businesses, but the likelihood is that this will require a claim in a self-assessment return. And just one final point on the losses. HMRC are stressing that claims by companies for extended loss carryback shouldn't be made until Finance Bill 2021 receives royal assent, and that's expected to happen around about the middle of July. So that's the first measure. So the second measure then looks at the 130% super deduction, which the Chancellor, using one of his famous acronyms, has been badged as Splash Out to help out. So this is where, for a 2-year period from April 2021 until March 2023, a company that invests in certain new plant and machinery assets can benefit from 130% first-year capital allowances. So obviously the benefit there would be to save corporation tax at 19%, and that roughly works out at about a saving of 25 pence for every pound spent. And that's very favourable compared to the usual 18% rate. Now, if the asset is not new plant and machinery, if instead it is a qualifying special rate asset like a long life asset or an integral feature, such as those integral to a building, for example, a heating system or a ventilation system, the benefit reduces to a 50% first year allowance. But again, that still compares very favourably to the usual relief at 6%, which is available for those assets. Now, a couple of points just to mention in relation to the super deduction. So these new allowances are actually available in addition to the ongoing annual investment allowance limit, which is currently £1 million until the end of 2021, and which already gives reliefs for costs of qualifying plant machinery, including integral features. So some businesses may need to decide if it would be more favourable, which it clearly would be, to claim the annual investment allowance on the integral features to get 100% relief there instead of 50%. Commercial vehicles can qualify, and again, as part of that, just be careful around the definition of van compared to car, but commercial vehicles do qualify. However, expenditure on assets that are used for leasing purposes do not, unless it's not technically leased. For example, if you have a landlord area within a property, such as a reception area, that's not technically leasing to the tenant, that potentially can still qualify. It's only applicable to new assets, so used and second-hand assets are specifically excluded. And there are, of course, additional conditions for assets bought under HP or a similar contract. Now, the big thing for me is to look to the future. So what happens if these assets are sold Well, essentially, they are tracked in a separate pool for capital allowances purposes. So that means that the disposal proceeds will automatically create a balancing charge if they're sold and there are some proceeds realised from their disposal. So there is a really important point around tracking and tracing the qualifying spend. And of course, if you think about it, when the corporation tax rate in the UK increases for profits above 250,000 to 50% from April 2023, if the balancing charge is triggered after that date, this means that the balancing charge is taxed at 25%, whereas the original 130% relief only received relief at 19%. So that's just something to bear in mind. Now, the next measure just I want to briefly touch on is the changes to the IR35 private sector off payroll rules. So these rules can apply if a worker or someone sometimes calls themselves a contractor provides services to a client through an intermediary of some type, for example, their own limited company. The rules were extended to the private sector from April 2021 after a delay of 1 year. And essentially, it places a responsibility on medium or large sized private sector businesses to now decide the employment status of contractors, which essentially means paying tax, deducting the PAYE and national insurance as if that contractor were actually an employee. There is an exemption within the legislation, but it's not overly generous. It's referred to as the small exemption, and it's only available if the business meets 2 or more conditions, either annual turnover less than 10.2 million, or a balance sheet total less than 5.1 million, or less than 50 employees. So you can see quite a few businesses can easily be caught by these rules where perhaps they don't have the specific skill set within their own business and are forced to use contractors. Just note that where the exemption is not available to the business, the onus is obviously, just note that where the exemption is available to the business, the onus then shifts back to the contractor to decide their status. Are they an employee or should they be still treated as a contractor? Now, as part of this, specific areas to watch is obviously businesses should be assessing the different contractual relationships they hold with contractors and review contractors that are currently already working within their business. The key is to assess if the contractor is inside or outside the new rules. And in order to do that, you can actually use HMRC's Check Employment Status for Tax tool on gov.uk to help make that decision, which HMRC has set out that it is sufficient if you properly complete that check, that this can provide reasonable care if, for example, there was an inquiry at a later point in time. And finally, what I would say is look wider than just the tax. You do then need to consider if you have contractors that are impacted by these rules to examine how your HR and payroll system will cope with the tax treatment of these contractors and will properly capture their treatment going forward. So that's the IR35 changes. Now, the next one is an interesting one, probably for our not international members from the South African Institute, but I thought I would touch on the stamp duty land tax surcharge for non-residents, because this is kind of snuck up on a lot of people. It was trailed a few years ago, but it's now come into play from the 1st of April 2021. And this is despite the fact that we actually have the extension to the 0% threshold for purchases of residential properties in England and Northern Ireland. So there is a higher 0% threshold until the 30th of June. That essentially should still be taken into consideration when you're looking at this stamp duty land tax surcharge. So yes, there is this surcharge if you purchase a residential property in England and Northern Ireland and you're non-resident. But bear in mind that the increased 0% threshold is still in operation until the 30th of June, with a further increased threshold available until the 1st of October. So what I would say there is just don't take HMRC's guidance for the word it produces here, because we have asked them to make sure that it's clear from the guidance that this higher 0% threshold can actually be taken advantage of by non-residents. Now, a couple of other areas to specifically watch for your non-residents is firstly how this particular rule interacts with the additional 3% surcharge, which can apply for purchases of additional dwellings. Essentially, this 2% would be on top of that 3% as well. And I suppose just for clarity, remember, stamp duty land tax only applies to purchases in England and Northern Ireland. If you're dealing with someone who's making a purchase in Scotland or Wales, it's really important to check the specific rules which apply in those areas. And then the final point in terms of who is a non-resident, there are specific stamp duty land tax residence tests that apply to determine the purposes of these rules if the 2% surcharge applies. So your normal tests go out the window and you must check these specific tests. Now, the final point I want to just touch on here is the changes to corporation tax. So essentially, these really big changes come in 2 years' time. From the 1st of April 2023, your rate of corporation tax will increase for profits over 250,000 to 25%. The rate for small profits under 50,000 will stay at 19%. And in between times, we have this marginal relief that gradually, as your profits get closer to 250,000, increases the rate of corporation tax. Of course, this does beg the question if the time is now right for Northern Ireland to revisit its legislation on a lower rate of corporation tax. And that's why the recent Fiscal Commission has been established in the region, which Chartered Accountants Ireland has actually been in touch with to offer our guidance and assistance as they work through this particular issue. But in terms of areas to specifically watch, the limits that I've mentioned, the 50,000 and the 250,000, must be reduced for accounting periods of less than 12 months. They must also be reduced by the number of associated companies. So the concept of related 51% group company, which came into play in 2015, now goes, it disappears. And essentially the regime we'll be looking at in 2 years' time, which I'm sure many companies and software providers are working towards ensuring they are ready for, bears a really strong resemblance to our pre-2015 regime. So dust off those old rules and make sure you're ready. If we could move to the next slide, I just want to briefly touch on some other hot topics in tax before I wrap up. It's not moving on there, Karen, at the moment, but really what I wanted to cover in the next slide was the engagement we have via various fora and government bodies with HMRC and the government. And I want to encourage members to keep up to date by signing up to Chartered Accountants Tax News, which issues every Monday if you haven't already done that. Firstly, on EU exit, very briefly, we're still meeting with HMRC, various government bodies, including InvestNI and the Department for the Economy. We're also having regular meetings with the Trader Support Service to discuss the post-EU trading landscape, and we would encourage members to contact us with any problems or issues they're actually facing. At the moment, a key piece of work is business readiness, not just as certain grace periods end later this year, but also given the fact that many businesses have been closed since before Christmas. So they probably haven't been buying from the EU until now. They haven't been buying from GB. Once they're newly out of lockdown and reopen, these issues will all start to come to fruition for them and potentially cause issues. And then finally, in terms of key consultations, we're seeking feedback in relation to the tax advisors consultation that will be coming. It's due in, I think it's due in the middle of June. We'll be asking for your feedback in tax news. We'll also be asking for feedback on your timely payment consultation. And I don't think I could finish my piece without mentioning Making Tax Digital. Yes, that's still coming down the tracks, guys. From 2022, the next stage happens for VAT. We expect income tax to happen in April 2023, and at the earliest corporation tax from April 2026. As a final word, we continue to engage with HMRC on all of these matters, and please do get in touch at any time if you have anything you'd like to feedback. Thank you.
Thanks so much, Leontia. That's a great whistle-stop tour of all the main issues. And now we're going to have Willo present to us the COVID-19 supports and the risk issues and the exit strategies. So I'll leave it to you to take it away there, Willo.
Thanks very much. Good afternoon, everyone, and a pleasure to be here with you this afternoon and talk through basically exit strategies around COVID and what the risks are. And we'll try to cover on a broad range of risks, so not just tax, but accounting, administrative, and just general business risks as well. If you could roll the slide forward, actually, please. And one more, thank you. So there's probably a number of ways we could run this discussion, but what I do want to focus on is what have been the key COVID relief measures, how extensive they've been, and which ones are likely to give most consideration to businesses like yourselves over the next few weeks and months. Obviously, the big presumption here, and hopefully it will all come to pass safely, is that we will continue to lift the various lockdown restrictions we have. Actually, if you come back just one slide, sorry, don't, yeah, perfect. We will continue to lift the various lockdown restrictions, and hopefully by the 21st of June, we will be largely back to normal operation, at least from a business viewpoint. I've listed out here some of the key relief measures, and if you jump onto some of the various websites, if you do a quick Google, the list of actual individual relief measures is quite lengthy and quite extensive, ranging from some of the broader measures like the COVID job retention scheme, which we popularly refer to as furlough, to the VAT deferral, all the way down to some quite niche reliefs that are quite industry specific, and even some relieving measures which were granted by local councils. And I think I'm safe in saying, and it'd be interesting to see if there was a poll, I would imagine that pretty much well over 90%, maybe even closer to 100% of businesses would have had some benefit from one of these COVID relieving measures at some point in time. So whether you were in the furlough regime, pretty much all my clients actually opted for the VAT deferral, right down to things like the administrative extension for filing your annual reports with Companies House, to business rate reliefs, and even some of the tax relieving measures that Leontia just talked through a few minutes ago in terms of lost carrybacks or other super deductions. All of that can be seen as part of the broader COVID relieving measures that have been very, very extensive. And if you can move on a slide, please, thank you. And I think part of it being so extensive and it having touched so many parties is that it is worthwhile that every business has a think about what relieving measures have they been benefiting from or relying upon, and how are they going to step back and get back to business as normality without that relieving measure being there. And as I said, it could have been a small temporary relief like postponement of IR 35, and now that is going to come upon you, or it could be a more serious one like the furlough. And this slide here, which I've borrowed from HMRC's website, does actually show not just the extent of the furlough measure. So at one point in time, pretty much 9 million employees were benefiting from it, but it also shows the complexity that was associated with it. So each cliff edge jump up or down that you see on the chart here essentially correlates to a change in the rules as well. So as either COVID measures relax or COVID measures restrictions were reintroduced, the rules changed. And I think there's been five or six separate extensions to the furlough regime, and every time it was extended, the rules also differed. And if you can move on slide, please. Again, this slide kind of, which you'll see when it's shared with you, again captures pretty much the same thing as how the scheme changed over a period of time. And was this graphic largely captures changes in terms of the percentage salaries that the government were subsidizing. behind the scenes, there's also been a significant number of changes to the guidance. And again, if you can move on one slide, please. Thank you very much. So sticking with furlough, because it is one of the bigger impacting relieving measures, and it's possibly where we're seeing most activity at the moment, is as businesses step away from it, what kind of measures should you be taking at this point in time, both from a tax viewpoint, but I'd also like to touch as well on broader range of things. Looking at it more from just a pure operational of the rules, and I won't spend any time on fraud, but if you just quickly Google furlough fraud, you will get a huge range of hits there. So the HMRC are pursuing fraud cases quite aggressively, and we will see those going to court in the not too distant future. But just focusing on just pure innocent mistakes, which can happen to any of us, and why that might happen, and why it's worthwhile looking at it now. So to the extent that your business has been benefiting from furlough, it is worthwhile doing an exercise at the moment just to make sure you're happy that all the calculations were right. And you might think that the calculation should be straightforward. Surely it's just identifying an employee, getting 80% of that employee's salary, capping it at 2,500, and that's all that had to happen. And if that's the case, great. But what we find is that the vast majority of employees actually had more difficult circumstances than that. So whether it was being paid for overtime, zero-hour contracts, bonuses, commissions, share schemes, people who were on mat leave or pat leave, all those factors were never considered on day one when the rules were announced by the Chancellor. So he announced them on such short notice that the regulations themselves were extremely, extremely thin. And it's only since then that HMRC has put out guidance, largely in response to questions from business or professional bodies such as our own Chartered Institute of Ireland. And that guidance has also changed over time. So it is worth double checking that whatever you're doing is now based on up-to-date guidance. And initially, the guidance expanded almost on a daily basis. So last April, May, we were seeing daily changes to the guidance. That pace of change has slowed down, as you would imagine. But things like commissions, HMRC have totally changed their view on that. And so why this is important is understanding what has changed, tracking that, and being able to go back and make sure that your employees were paid the right amount under the furlough scheme, you claim the right amount under the furlough scheme, and that may require adjustments up and down to either or both your employee as well as with the HMRC. And as I said, that can be very difficult to track, especially if you're a decentralized business with a headquarters somewhere in the UK and a large number of outlets around the country where you might be relying on information being provided from a small team, and it may not have been as up to date as one would like. So we are starting to see HMRC launch inquiries into this, and definitely the extent that you're in a business that might be looking to sell or have an audit shortly, we are seeing the auditors or due diligence providers ask relevant questions about calculations and wanting to make sure everything has been checked and double checked. And then the final one, which I won't dwell on too long, but there has been a large number of companies who have come under pressure recently because their results have been quite good, but it's also known that they've claimed furlough, and some of those have actually returned their furlough payments to HMRC. And again, that might sound easy, but it's actually not as straightforward a task as one would imagine. Moving on, I think also on employees, if we move on to the next slide as well, thank you very much. With furlough, it is a huge scheme, and to the extent that it has businesses have benefited from it, it is quite a big change. So you're moving to a situation where some businesses have had employees on furlough for up to 15 months now, to them coming back to work. And again, that is easy to say. In practice, it's quite difficult, and it does take a lot of planning. So the obvious questions that you're probably thinking of is, well, am I confident that 100% of the employees will actually come back? To what extent does retraining need to happen before they can come back into the job, especially where you're heavily regulated and regulation may have moved on? We have situations where employees have just left the business and are about, because they could still be working on. Remember, one of the oddities of furlough is that they could take up a second employment. They just couldn't work for you, but it could actually work for someone else. And might it be that they're actually going to remain with that second employer? So all of those things have to be tested. And also, we've seen a lot of employees actually leave the UK and return overseas for the COVID period. And will they actually come back to the UK? So I think London, for example, the depopulation in London has been about 750,000 over the last 12 months. All workers who have left London, and most of them left the UK as well. Moving away from COVID, the furlough scheme, it is also very important to track what other relief measures that you may have been benefiting from, and make sure that you're aware of the exit strategy and the wind down. So exit strategy being, how long more does the actual relief run for? To what extent is that impacting your business? And to the extent that you have been relying on that, is there a way of making good the deficit that there might be? So, for example, if you've been, if you're on a time to pay for one of the taxes, and you had a 12-month arrangement with HMRC to pay over some PAYE or corporate tax, and that's now about to expire, and you're getting back into the normal flow of payments, are you budgeting for that? Is that in your cash flow, and can you manage that? Simple things as well, even if you haven't had employees on furlough, but you've had employees out of the office. Again, how are you preparing for that return to the office? We hear new phrases like hybrid working, the future of work. And there is a lot of pressure on businesses, just because quite often competitors will be in the media with them doing new and innovative ways of working. So whether it's giving people a half day every second Friday, or telling people just they don't need to come back into the office. Impractical for some businesses, fully agree, but to the extent it is an option, people will ask for it. And maybe you might actually be a business where 90% of your workforce have to be on the floor. So let's say it's manufacturing or your hotel or leisure, but maybe 10% don't need to be. But the tradition is that they've always been there side by side with the colleagues, but you might have pressure on that going forward. And it's how is that going to be communicated? And what we've actually seen with some businesses is they've actually done a lot of work to improve office facilities, so new canteens, new breakout areas on the floor, increased spacing between desks, improved ventilation, and spent a lot of money doing that. But what unfortunately has happened is that the communication of that hasn't been as effective as one would like, and therefore all this benefit actually hasn't landed as well as one would like. And then my final point there is we spend most of this discussion on the UK, but bear in mind that a lot of these reliefs have similar reliefs internationally. And I think it's also worthwhile getting on top of those. To what extent are you benefiting from furlough equivalents in any other international territory, and how are you going to unwind from it? So I'll probably leave it at that, Norah, and pass back to you.
Yeah, and Willo's not going to go anywhere. We're going to come back and have a couple of questions with Leontia and Willo just after myself and Tiarnán have a discussion about his experience of running a business through what can only be described as probably one of the most challenging times, understatement of the year, that any business could ever have come across in terms of COVID-19 restrictions and Brexit. And particularly in your area, Tiarnán, you're running a large award-winning hotel, and dealing with a large workforce that actually has to be on the ground. And you can't be sending them home and working remotely. You can't do a barista from remote access. Would you mind sharing with us some of your experiences over the last year and what's been the hardest point of the year?
Yeah, no, like Norah, thanks for the opportunity. I suppose where we have the Galgorm collection, we have 3 hotels in the north, and we have 2 restaurants in Belfast, and each of them have, that they're different markets, and then with COVID they've had their different challenges. And we have about 750 employees across the group as well. So I suppose we came into this, one day, booking sitting at 97% occupancy across the properties, trading very, very well, as we always do, and then nearly overnight shut down, no money coming into the bank, and what do we do with these 750 staff? And then, very quickly after that, the government schemes came on board and so on. But there was that period of a few days, maybe even a week or a couple of weeks, where, what is going to happen here? And like myself and the managing director at Galgorm, Colin Johnson, like we were invited on to industry groups with, Conor Murphy, the finance minister, and Diane Dodds, the economy minister, to try and work through these schemes. But there was a point here where we literally thought doomsday is going to happen here. Where are these government schemes, and what's going to happen? And then I suppose, the year went on, like I had never heard of furlough. And then very quickly you're trying to understand, well, exactly how do we calculate this? And, we're very lucky we have a payroll team who have been exceptional throughout this, and they've got the terms with furlough, then flexi furlough, and so on. So, the challenges have been, we've dealt with them, between furlough and then you look at the banking relationship. And I found that we went from a position of strength to having no issues with our bankers, knowing that our covenants were there, but not really, we beat them every year, no bother at all. And then all of a sudden to, having to, rely on your bank very quickly for the CBILS loan, for overdrafts, for working capital, and so on. Like we came into this, we had the working capital was one thing to be dealt with, but we still had capital commitments. We bought a new property and we were refurbishing another, and all those payments had to be made per contract, along with trying to find the cash to pay the suppliers. So typically in our industry, the agreements we have with our suppliers are 60 days. We closed in March, we're still paying off January, some of December suppliers. So, there was all of that, and then working through with insurers and everything. So, our finance team were busy before that, but I think as we closed, where the accountants came into their own, and we became even more busy, and we were nearly the cornerstone that kept the business ticking over.
We hear that right across all our members, just the dependency, their skill set was so necessary during all of the COVID restrictions and trying to access all these supports. In your view, Tiarnán, did the furlough scheme do what it was intended to do? Did it keep the link, do you think, between the employer and the employees, such that you'd be ready now to reactivate your workforce once things start opening up again?
No, the furlough scheme definitely has protected jobs. It's definitely protected the jobs of our employees, because, as I said, we have 750 staff. There's no way our business or any other business, could have kept those wages coming, or even enacted temporary layoffs. Like we have our contract employment allows us to do temporary layoffs, which we've never enacted, unlike some of our competitors. So, our 2 shareholders on our board were very adamant, that our priority here is the jobs and the people that work with us. We've had no redundancies, but the furlough scheme allowed us to honour that commitment and to protect those jobs. In terms of, the calculations and the legislation and all is one thing, we've had, it has changed a number of times, and I suppose it's HMRC got to grips with what exactly the scheme was, and as it developed over time, so have the payroll professionals and so on. It's protected the jobs. Our issue is that as we move to reopen next Monday, all being well, is bringing those employees back to work. So some of them, there's a number of camps. Some of them are after being off for nearly, you know, well over a year. So some of our employees, because hospitality hasn't reopened fully in any shape or form, a lot of our staff have been off for well over a year at this stage. And it's trying to coax them out of the house, convince them, you know, that coming back to work, coming into an environment, you know, it is safe, and that we will do what we can to protect them. Then you have the others who have went, and maybe, you know, furlough allows you to have dual jobs. So while they were furloughed with us, they were allowed to go and get a job elsewhere, and it's trying to get them to come back from that. And then equally, we've had members of staff who had transpired, and we've invited them back to work. Some of them, you know, we have a couple of examples of staff who are from Eastern Europe, and they have gone home over the furlough period, and they're struggling to get flights back. So, you know, it's a mixture.
Oh, absolutely. It's just, you know, all sorts of connotations in trying to run a business that one would never have even dreamt of thinking about this time 2 years ago. It's incredible, all the things that a business has to think about now. Tiarnán, if you were to ask the government for one measure that you could see would be of enormous help to the hospitality sector, what would that be?
You know, there's a few, but I suppose that's, you know, one of the schemes that was introduced was the reduced VAT rate for tourism and hospitality business. So we went from 20% to 5%. Now, given how lockdowns have all panned out, you know, none of our businesses have really had the benefit of that. So I think, you know, to give the sector the boost that it needs when it's coming out of all of this, you know, if that could be extended. So I know there's talk of it, you know, 5% until September, and then that'll increase to 12.5%. But, you know, to keep that as low as possible would be a real boost to the industry. Like, you know, some of our businesses like Galgorm, which is our sort of flagship resort, you know, we will have a busy summer, 97% occupancy, back to what we're used to. But that's typical for every summer. So while it will recover quite quickly, you know, we have restaurants in Belfast, and, you know, the future for them is more uncertain than our other properties. And, you know, so we need all the support we can get. Similarly, you know, we're quite lucky because our hotels are, you know, quite reliant on the home market. But if I had a couple of hotels in Belfast, or a hotel in Belfast, you know, that was reliant on the international tourists and so on, you know, that bounce back won't be quite as quick, and that will take some time. And there's talk of that sector, you know, that type of visitor, the full recovery mightn't be seen until 2024, 2025.
Of course, it's just, yeah, it's so hard. So look, we know now what to be lobbying for on your behalf in our representations work. I'm sure Leontia is taking notes here as we speak. In terms of Brexit, has it all been about survival, getting through COVID, or has Brexit been bothering the minds of businesses, particularly in the hospitality sector as well?
Those were, you know, Brexit for us, you know, given where we were with COVID and all, came and went. We do quite a lot of our own building work, and so we source materials and so on. And, you know, while we can source materials from China quite easily, actually physically sourcing materials from GB initially proved to be a bit difficult with the ROI numbers and so on, but we've come past that. The only sort of big piece of work for us was the settlement scheme, and making sure all our employees had, you know, the right paperwork and the right visas and the right work and all that there in place. Yeah. So maybe there's something to come from Brexit that will identify when we reopen fully, but it's come and went for us at this stage, and the priority's been trying to battle through that global pandemic. So it has.
One hassle at a time. That sounds like it's only what one person can deal with at a time, or one business can deal with at a time. So listen, I'm going to call back our other speakers, so Leontia and Willo. Just a couple of questions for you. Leontia, the corporation tax increase, that's flagged to go ahead in 2023. But do you really see it going ahead? Is there anything that can be done, or is there any rumblings with opposition parties or with industry that the corporation tax increase is just untenable?
Well, unfortunately, at the moment, Norah, there's not much talk that it won't happen. I think, you know, the opposition parties recognise that the cost to the exchequer of the pandemic, the cost to the government, has been ginormous, into the hundreds of billions. So at the moment, there isn't a lot in terms of rumblings that 25% increase won't happen in 2 years' time. And I guess what I would say is, you know, watch the space, because things do change. I mean, we have seen over the course of the last year with the job retention scheme, the Chancellor making very clear that they wouldn't be extending it, but things suddenly changing at the last moment. So at the moment, whilst there's no kind of talk about changing the rate and keeping it lower than 25%, I would say is just bear in mind that anything is actually possible. I mean, if you look at what happened with the 17% rate, we were due to go to 17% from the 1st of April 2020. That didn't happen. It stayed at 19. So anything really is possible, but at the moment, I'm still expecting it to be 25% in 2 years.
Of course, we have global tax reform and a minimum global tax rate of 21% carry dollar back. So it's just, it is important for businesses to plan for that corporation tax hike. And the super deduction, or what was it you said the Chancellor was calling it, the super...
Splash out to help out.
Splash out to
on these eat out to help out, splash out to help out schemes. Yeah.
The splash out to help out, does that apply to corporates, or is that available to sole trade businesses partnerships?
Unfortunately, it is only available to companies. It's viewed as a way of the Chancellor, I suppose, soothing the pain in advance of the increase to 25% from 2023. But don't forget, unincorporated businesses can still take advantage of the 100% annual investment allowance limit, which provides relief for new plant machinery, including integral features. And that's still a very generous limit of £1 million until the end of this year. Now, we do expect it to fall back to 200,000 from January 2022. But again, who knows what will happen? What I would just say is if it does fall back to 200,000 from next January, there are very complex transitional rules. If you're in a situation where you're an unincorporated business and you have an accounting period that straddles 31 December 2021, there is quite a funny calculation that needs to be done, and it can actually restrict the level of the annual investment allowance in terms of your capital spend. Okay, so again, as you always say, the devil is in the detail. The devil is in the detail. Don't look at the headline, look at the small print. Absolutely. Willo, in terms of HMRC's activities for the COVID supports, and if we think about the wage support, the furlough scheme, will they be going right back to the original launch of the scheme, or is there a specific time frame for their reviews, looking for, let's say, errors, mistakes? Like, are we going all the way back to March?
All the way back to March, potentially.
Okay.
Unfortunately, and that's part of the issue, because this happens so quickly. Question to what extent businesses might have all this properly documented. And businesses would have been working as quickly as they could have done. They themselves were possibly reducing their headcount in some cases because they were putting admin and finance and payroll teams on furlough as well. So because furlough wasn't just unique to the front office, it was back office also quite often was subject to. So question to what extent the records exist, question to what extent companies were following all the guidance changes, because a lot of this just went on a website, and unless you were aware that such a website existed and it needed to be updated and tracked on a regular basis, you probably could be 6-12 months down the line and somebody said, well, did you include average out, if a person's on a 0-hour contract, did you average out the last 12 months or something like that? And that's kind of where the tricks can happen with it. Yeah.
Oh my goodness, that's because I just look at your chart there where you had, the break in the changes. That there are a hell of a lot of changes for businesses.
Correct. Yeah.
So it's and like that's something we could talk to HMRC about. Like if there is, let's say, a one-stop shop when it comes to trying to figure out all the different changes to the guides. Have they been well documented, Leontia? Is it easy for a business to follow now, or is it a question of having to go back and find each iteration of the guide?
You still need to check, Norah. What they tend to do is if you launch at gov.uk right now, it would be the most up-to-date version. But in terms of previous versions, one of the pieces of advice I would have given, and it's actually, I can't believe it's a year, but we did a webinar with the Ulster Society last April on the job retention scheme. And one of the key pieces of advice we gave then, and it's ironic how important this is, was to make sure that when you were sending in furlough claims, that you actually kept a record of the guidance that was live at that point in time, because things get updated. And whilst you can access archive to a certain extent, there have been so many numerous changes to the furlough guidance in the last year. It's just been incredible. Now, as Willo said during his part of the talk today, it has, I suppose, it's decreased in terms of more recent months. There haven't been as many changes, but at the same time, there are changes coming from the 1st of July in terms of the employer contribution. So this still is a moving feast. And I think that's my key piece of advice would be anytime a business sends in a claim, keep a record of the live guidance, print it off and date stamp it so that you know, when HMRC do come calling, and they will call in certain businesses, that you're able to stand over. This is the action you took based on the guidance that was available at that time.
Okay, so much for virtual office. Get printing.
Yep.
Print off your guide ASAP.
Printing.
We have a question here from a member of the audience. In respect of the furlough fraud, how would HMRC view a business that did suffer in the period March 2020 to August 2020, claimed the JRS, but were able to get back to business and then have been very profitable since? Could HMRC require a furlough payback? Do you want to have a go at that one, Willo?
Yes. So long as you're complying with the rules, the fact that you then subsequently become profitable is not part of the issue. If you become profitable afterwards, that's great. I think the becoming profitable afterwards or being profitable throughout and still claiming furlough is more of a reputational issue. And there are a number of large companies that have come under the media spotlight for putting people on furlough, claiming the furlough subsidies, but still remaining very profitable. Now, they probably were fully entitled to put the people on furlough because those part of the business may have been pretty quiet and not doing something, but another part of the business was highly profitable. So a classic example that we saw was initially when COVID kicked in and it all just went off a cliff, you didn't need your sales force. And you probably had enough stock in your warehouse that you could continue to push stuff out. So you could have let your sales force go for put them on furlough for a month or so. It was a minimum of 3 weeks at the time, but you kept your warehouse and your manufacturing. Then when you got to June, July, and everything had slowed down even further, people were saying, well, we don't need the manufacturing people. So they were cutting the manufacturing, but they were bringing back the salespeople because it was starting to look a bit better at that point and they were ramping up the sales. So you could see, and that company could be profitable throughout because especially if you're just releasing your inventory and recovering all your debts, etc. Your balance sheet and your cash and your P&L actually looks quite decent in that time, but you're still managing everything. So you can see how businesses could be profitable but still have quite complicated furlough issues.
Sure. But the main thing, it doesn't preclude you from being profitable so
No.
long as you made the claim in good
correctly
faith that you were in trouble and that you have the details to back up that you were in trouble at the time you made the claim.
Correct, that's right, yeah.
That's the key. And Tiarnán, from July, the employers are expected to make a contribution to the furlough. Will this bring a lot of challenges for businesses? Is 1st of July, is that too early? Or should it be enough time for employers to be able to contribute?
I think it depends, Norah, on the high hospitality, from hospitality perspective, how the business performs and what the appetite is. If we have another, we keep hearing of this Indian variant and so on. If that leads us to confidence falling among our customers and so on, then it could prove to be a very difficult summer. Where we're at, based on business of the books at Galgorm and at our other 2 hotels, listen, that we would hope to be well rid of furlough largely come the 1st of July. We would hope come the end of May, start of June, that all our staff are back doing what they do best, and we quickly try and move to put furlough behind us. But it all depends on how, what the public health is, the messages are coming from government and the situation in hospitals and so on. Like, everybody's priority is to make sure that the NHS doesn't get overwhelmed and so on. But at this stage, given the bookings we have on the books and so on, no, we would hope to be well for putting furlough behind us come the 1st of July.
Okay, well, that's good news. That's certainly good news. And it, for those employers who, are dealing with all sorts of variables, the 1st of July, hopefully we'll see them right and should be in a position then to be able to manage it. Coming up to the last couple of questions here. Leontia, what would be, do you think, is HMRC's approach to policing the IR35 private sector rules? Are these going to be something that the audience here really need to be on their game about?
Well, I think it's probably not unlike quite a few other big changes we've seen in UK tax legislation over the last few years, whereby they're initially taking what they call a soft landing approach, where your business has genuinely made a mistake. So the business has tried its best. It has taken reasonable care in terms of assessing the impact of the changes on their particular contractors. So what they've told us is they'll not charge penalties for those taxpayers in the first 12 months. So that's up to April next year. Now, that's irrespective of when HMRC might find out about the mistake. It might take them a few years to find that mistake. But, of course, and this is only to be expected, if there's deliberate non-compliance, they will act and they will charge penalties in those scenarios. So if your business has genuinely made a mistake and has taken reasonable care, we wouldn't expect to see any penalties in the first 12 months. But after that, I suppose this is the opportunity for HMRC then to check that these rules, which they have, of course, been delayed in introducing for a number of years, it's their opportunity to make sure that the tax that they expect to see coming into the Exchequer is actually coming in through the doors.
Okay, and I presume it's well documented about the stay of execution on the penalties.
Absolutely, there is actually a specific briefing published in their on the website on gov.uk. In fact, actually we covered it in Chartered Accountants Tax News a couple of months back as well. But I would keep an eye on that as well, because obviously as the year moves on, we might see a slight change or a slight nuance in their approach.
Absolutely, it's always you can't take these things for granted. HMRC, like everybody, has to respond to the situation. If they feel there's anything there that they need to respond to, nothing's going to stop them from doing that. Well, look, I think that concludes a very helpful session. I certainly have learned a lot from the briefings that you've given here today. It's been very helpful. I think, from our discussion there that we've had offline, the work of the Chartered Accountant has never been so important. It's really been the linchpin for businesses throughout these last 2 years. All the various government supports, all the projections, all the keeping an eye on the cash, that's all been falling on the shoulder of accountants in business and in practice. So it's really crucial, the work of the members over these last 2 years, and how important that's been to keeping businesses going. And absolutely, that reflects, I'm sure, every one of our speakers' roles here today. So I would like to thank you very much for joining us. I'm sure you found this a very helpful session. I would like to thank our people who have been making sure this event came about today. Denise Jones, who looks after the London Society, Karen Hewitt, who looks after the Ulster Society, and Sarah Jane Varney, who looks after South Africa Institute of Chartered Accountants. So that leads me to conclude here today and wish you all the very best in the next couple of months as we all get back on our feet and get our businesses going again. The recording will be made available and will be issued out to you later today or tomorrow. So thank you so much for joining us, and thank you so much to our speakers.
Thank you. Bye-bye.
Take care now. Bye.